Hey everybody, I hope everyone is doing well and had a good day. This is going to be a recap of the Emini 5-minute chart for Tuesday, April 15th, 2025. And because the gap was small and we have overlap with the prior day, first of all, I will assume that the Globex session was a trading range. We had a small gap, probably went sideways, whether it was big up, big down, or in a tight range. But I want to demonstrate that it's okay to look at the Globex session or to look at the RTH chart, the regular trading hours chart only, especially when the context is like this. And to start off today, I think it's important to incorporate yesterday's price action. So even just from here, bar 50 or so, tight bull channel, and then a significant trendline break by the bears. This breakout traps a lot of traders. And what happens, the traders who bought up here get trapped into a losing position as the market sells off. And what does that create? That creates resistance above. And if we just take the swing point, this is not yesterday's high. It's sort of below, but this was a significant major swing point. So at this point, it's clear. It's big up, big down, and big up again. So the market is very likely in a trading range. Traders are buying low, selling high, and they're scalping. Now the range is fairly broad, fairly big swings up and down, but the dominating fact is that you want to look to buy low and sell high. So bull trend, trend line break, retest, probably sellers up here, and probably wise to look to sell up here. So look at bars 2 through 5. And you could say the gap up, you could say 1 through 5, doesn't really matter. The point I want to make is that bar 2 is a breakout bar, and then we slowed down on 3, pulled back on 4. This is a spike in channel on a smaller time frame. Bull spike, pull back, and then we channeled for a couple of legs up. And we're trying to break out of resistance, but even with that aside, we think about the market cycle. Spike and channel, you expect this channel to evolve into a trading range, which it does. Bar 6 and 7, we go back and retest where the market pulled back, trapping stop orders below 3. So there's some temporary support here. And then we rally again for the second time, or you could even say the third time, on bar 9. Because we rallied on 3, pulled back, rallied on 5, pulled back, rallied on 9. So some traders will see 3 legs up. Other traders, they count 2 breakout attempts of this swing point from yesterday. Bar 5 could not close above. Bar 9 could not close above. And now, big picture context, let's think about where we are in the market cycle. Big up, big down, big up, and now confusion. We're going sideways. So if we're big up at the top of a trading range and there's no momentum, then the bulls have lost their edge. They need momentum. They need to control price. And if they're not, bar 6 is a warning. 6 is a strong breakout bar. It's probably going to get a second leg, and there are probably sellers above bar 6. And if you're a bull and you bought for any reason up here and you get bar 6, the risk is real that we go all the way back below bar 1. Is this going to be a bull trend from the open? It might be, but bar 6 was a problem. And then, of course, bar 10. But the point is, if it's a trading range, and this is a swing up, swing down, swing up, we can come all the way back down to bar 1, or even bar 80 yesterday. So when you get a breakout that traps traders, bar 6, bulls will use the rally to exit longs, and bears will use the rally as a pullback, a breakout pullback, to sell. So that failed rally, the failed breakout of this swing point, bar 9, is a third attempt up at the top of a trading range. again, big up, big down, big up. So remember, buy low, sell high. And that's just what the computers did. And we got a breakout bar 10. Bar 10 is a vacuum test of support. It's a big bar. Big bars are not ideal to trade. They usually pull back, and they usually produce trading ranges which can last a lot of bars, and they can be contained within the bar, so the range can be fairly tight. As you can see here, bar 10, a big breakout bar, and maybe 20 or 30 bars stayed within the range of this bar in a tight trading range. On bar 10 broke out below bar 9, broke out below the prior 5 or 7 bars, and there's a micro gap. And what happened intra-bar on bar 11, from the high of the bar to the low, we got a 50% pullback. Bar 11 pulled back, came back and retested the close of bar 10. So the bears got leg 1, pullback, leg 2, and now where are we? You look to the left, big up, big down, big up, big down, and now we're back at the bottom of the trading range. If you view the gap up as a bull trend bar, then there are trapped traders down here at the bottom of the range, and bar 81 was a bad stop order signal bar. And that's going to act as support. So as we test it on bar 11 and bar 12, you can see the reaction, unable to break out below, unable to break out below. Or I should say close below. There's breakout attempts, but the bears were unable to get the job done. So then we get bar 13, strong bull trend bar. Kind of reminds me of bar 6. Strong bar, but the context is not so good. On the close of the bar, you're in the middle of the range, and that's not an ideal place to be trading. It's buy low, sell high, not buy in the middle and sell in the middle. So what do traders do? Rather than buy the close of bar 13, they'll buy a pullback, whether that's the bar 12 high, it's an inside bar, trading range bar, break out above it, retest the high, or we even tested lower. We came back to, let's see, the bar 1 low. The market also tried to break out below the bar 1 low, could not close below. And after bar 13, traders see a new breakout at the bottom of the range, but they don't want to buy here. They want to buy a pullback. We got a pullback testing the 12 high. Traders buy below bar 14, and then we get 15, second leg up to the top of a trading range, and testing the breakout point, the bar 9 low. So bar 10 broke out below bar 9, trapping traders. If you bought here, scaled in lower, didn't panic, use a wide stop, which of course not ideal to buy here, but even if a trader bought here, bought more lower, they were able to exit at their original entry and with a profit on their scale in. But now it's 2 legs up to the top of a trading range, and that's going to attract sellers. Bulls taking profits, bears looking to go short for the second leg down after bar 10. But the range getting incredibly tight, it's really difficult to trade when the range gets this tight, but that doesn't mean you cannot understand what's going on. The market is probing back and forth between perceived value, and it's oscillating between what buyers think is too expensive and what sellers think is too cheap, and it's really bouncing back and forth between these support and resistance levels. So as we test resistance, traders agree it's expensive, we better sell. Bulls who bought lower are taking profits. Bears, they see the context, breakout, pullback, they scalp for a second leg. And the range gets tighter and tighter until one side gives up and there's a new breakout. You can also say 11, 15, and maybe 23. 3 legs up. And another attempt to break out of this breakout point, the bar 9 low. So we tried on 15, failed to get follow through, tried on 18, failed, repeatedly trying to break out of this resistance, and then finally 24, a strong breakout bar. And 24, similar to bar 10, there's a micro gap and little overlap with bar 23. So if a trader bought below 23, 3-bar micro channel, it's a bull bar, bad, in general, a bad stop order sell signal bar. So there might be buyers below 23. Context, not great. You're at the top of a trading range. It's leg 3. But let's say a trader buys below 23. They get trapped on 24, and they use 25 to sell out of their longs at their original entry. They buy more lower, scalp out. Bears, if they missed the sell, maybe they did not sell below 23, then we get 24. Strong bear breakout from the top of a trading range, but you don't want to sell here. It's the same problem as bar 13. You're in the middle of the range. Buy low, sell high. So you want to look to sell high, sell the breakout point, 23 low, breakout pullback, 25, second leg down, and a third leg down. And now it's 3 legs down, back to support. It looks like we could not break out below the low of 17. You could also look at 15. You could look at the stop order, 14. There's a lot of options to look at for support. But what's happening? The rhythm of the market, breakout, pullback, breakout, pullback. A third attempt down, that's 3 legs, and we're at support. And we go outside up 29. Now 29, it's an outside bar. Outside bars are expanding triangles. And when they occur in a trading range like this, they're not as meaningful of a signal. It's really a trading range within a trading range. But it's a warning that the bull breakout, whatever the bulls get from this, may not be as strong as it could be, because we had a bear breakout attempt, we had a bull breakout attempt. It's confusing. The market is in a trading range. It's not clear that either side is in control. I do think the bears have stronger selling pressure up to this point in the day for the reasons I said. Bar 6 was a good bar. Bar 10, the strongest bar of the day. Bar 24, another good breakout bar compared to the rallies. It's really just a channel on a smaller time frame, whereas the market fell in just 3 bars from the 9 high to the 11 low, but then it took maybe 12 bars to rally from 11 to 23. And there's a lot more overlap and less traders getting trapped. But you know bar 10 trapped traders. You know bar 24 traps traders. And it's the same thing here. Bear breakout followed by a bull channel, bear flag. Bear breakout followed by a bull channel, outside bar, inside bar, rally, pullback, third attempt up. Notice the bulls are unable to get closes above this breakout point. And they did here, but they got no follow through. So the test of resistance is holding for the bears. And bears are selling here aggressively. And the bulls eventually would give up. You can also look at this as a contracting triangle. So the range is compressing or contracting. Different computers will draw the lines in different ways. You may disagree with the way I draw mine, but it doesn't really matter, because it's not the case that one single line is the absolute support and the absolute resistance. It's sort of a band, and there's going to be overshoots and undershoots, but what you're trying to do is get a best fit line, and you see every time the market approaches this upper line, this bear trend line, it sells off. We find resistance, and every time the market comes close to the bull trend line, we find support. And that's what's more important than anything. And so the way I had the triangle drawn, to me, 38 looks like a breakout of the triangle. I understand that other computers will say, no, we haven't broken out yet. But I think because I was a little more bearish with the price action through here. Sorry, I paused the video, lost my train of thought there, but to sum it up, it's a contracting triangle. Breakout direction is probably close to 50-50. It's not entirely clear that one side is stronger than the other, but I do think the bears had an edge today in this trading range. And again, some traders might see 38 as a breakout, 39.40 breakout pullback to the apex of the triangle, the midpoint, where sort of if the lines were to connect, that was sort of the price in the middle of the trading range. And then the reaction on 41 looks like a breakout pullback, and then the bears getting the breakout below the triangle more clearly here and follow through 42. Now I want to back up and just talk about 37 briefly. I was thinking about this. This is something that Brad talks a lot about, and you'll hear Al talk about it. You take the stop order perspective, and what if you ask yourself on every bar, would I rather buy above this bar on a stop order or sell below this bar on a stop order? And you can do that for every bar of the day. But there's two examples I want to show here. And the first one is bar 37. Would you rather buy above 37 on a stop order or sell below 37 on a stop order? And for me, it seems to me more clear that I'd rather sell below 37. We have a lot of resistance up here. It's the top of the trading range. You can call it maybe a high 2 if you were to buy above 37, a high 2, maybe a high 3, but at the top of a trading range. Whereas if you sold below 37, and if this is a trading range, and the bottom of the range might be all the way down here, there's clearly room to the downside. Of course, you could say there's the bull trend line, it's a triangle, and we might be testing support. That is true. But for me, if I had to choose between buying above and selling below 37, I'd rather sell below 37, and the decision is not too difficult. But for a bar like 42, I was doing the same exercise, and I thought, it's not all that clear to me if I'd rather buy above 42 or sell below 42. I know I don't want to buy above 42 because I think the bears are going to get a second leg down, and I think 42 is a weak stop order signal bar. But I also am not eager to sell below 42 because of the big tail, buyers into the close, and the location. Now we're in the buy zone, we're at support at the bottom of a trading range. So I just thought that was interesting, and I thought 37 was more clear, and we got the bear breakout, pullback, and then follow through. And down here at 42, it wasn't so clear, and then we ended up getting an outside bar, 43, and going more sideways. And today, based on the day, the structure of the day, it's clear that the market's in a trading range, and neither side is really in strong control. Because of that, any breakout we get, like here, we're breaking below maybe the past 40 or 50 bars. You have to assume there's probably going to be more trading range price action, and this is not likely to break out into a strong bear trend. Sell climax, pause, sell climax, pause. Sort of a deep pullback, sell climax, that follow through. So not bear trend behavior. And the bear channel, which was fairly tight, is becoming more broad. We know that channels evolve into trading ranges. So now we have 3, maybe 4 legs down. And again, for day structure today, what we might end up getting, which is what we did end up getting, is an upper trading range, bear breakout, and then a lower trading range. But because of the market cycle through here and the channel not being very strong, gaps closing, you have to wonder about the resistance above, and are we going to go back and test breakout points, breakout below this swing point, maybe the top of the channel is here, and maybe that becomes the top of a trading range. And eventually we did get the bull breakout of the bear channel, and ultimately, when you look at this section of the chart, maybe 42 to 81, you would call it a trading range. You wouldn't call it a bear channel, but it was a bear channel that evolved into a trading range. So let me back up. I kind of skipped over a lot there. Breakout strong enough for a second leg. Another bear breakout probably needs a second reversal, so another leg down is likely. Deeper pullback, and then another sell climax, probably sellers above, second leg down, but getting into leg 3 territory on a trading range day. So if you are selling here, you're scalping and you're taking profits at new lows. In a bear channel, bears sell rallies and they exit at new lows, and that's what's happening here. We get a rally, maybe 1 pullback, 2 pullback, 3 if they sell it. Big down, big up, they sell the pullback. And now we have 3 or 4 legs down. So a 3-bar micro channel, 59 through 61, strong enough rally and good enough context that it'll probably get at least a small second leg. And the micro channel grew to bar 64. You can say it's 2 legs, 1, pause, 2. You can even say it's 3 legs, 1, pullback, 2, pullback, 3. But when the channel is tight like that, you expect the first reversal to be minor. So even though you can count 3 legs, you can always count 3 legs. The market is fractal, but on a higher time frame, this is simply a breakout of a wedge bottom. And the reality is that 64 is probably not the bar that's going to reverse this rally and get all the way back down here. The bears likely need a double top at a minimum. So there's buyers below the first reversal attempt. It's a minor reversal. And this breakout is likely to get a second leg, which it did after a high 2 bull flag. But now 69.70 might be leg 2 at the top of this trading range. And because of that, you get a bar like 71. 71 is a decent bear breakout, and the context is pretty good. You have 2, maybe 3 legs up, double top in a bearish trading range day. And 71 is likely to get a second leg. It gets follow through selling, 72. Not the strongest bar, but it went in fair distance below 70. So the market moved a fair distance, 71, 72. Do you really want to buy above 72? And that's kind of that question again. Would you rather buy above 72 or sell below 72? And it's really not all that clear. I don't want to buy above 72. So maybe a high 3 at the top of a trading range. There's probably sellers above. But I also am not crazy about selling below it because of the buyers into the close of the bar. Probably buyers below. It's sort of the middle or approaching the bottom third of the range where traders were trapped down here. There's support. So kind of hard to answer that stop order question here, but what that reminds me of is that a bad stop order is a good limit order. Everything has an opposite. So if bar 72 is a bad stop order buy above, then there's a reasonable limit order sell, breakout, pullback, and you can capture a second leg. And you can see the reaction back at the bottom of the trading range. Tried to break out, reversed up. Tried to break out, reversed up. So that's it for this one. And as always, I appreciate everybody for watching and just want to remind everybody that if you have not studied the Brooks trading course, I highly recommend it. And this is for anybody who has studied Al. Even if you've gone through the course once or twice, I really recommend you keep going through it over and over and over again. And the information starts to compound and build on itself, and your growth becomes exponential. And it's really interesting. The content doesn't change. It's really repetitive if you keep watching the Brooks trading course over and over, but you're looking at it with new eyes and new ideas and new conditioning each time and a deeper understanding of the concepts. So while the charts and the videos don't change, your understanding gets so much deeper. It's almost like you're looking at a whole different course the second time through, the third time through, the fourth time through. So I'd really recommend everybody to study the Brooks trading course and then try to practice finding the concepts on your own charts and understanding the forces behind the market, support and resistance and breakouts, and really try to understand these things on a deep level, and then from there, that's your chart reading foundation. Then you can connect trading systems by connecting logical decision making with what's happening in front of you on the chart. And you can find the Brooks trading course and the website in the description of this video, as always. So I hope that's helpful, and I'm going to wrap it up here. So thanks everybody, and I hope everyone has a good night.